All right, welcome to Chapter 10, where we'll do some financial statement analysis. Some of these you may recall from Accounting 1100 as we introduced some of these concepts in a previous course, but we'll walk through some various slides. Hopefully they come back to you or make some sense, but they can all be found tied to the various financial statements that you do prepare for an organization. So in this chapter here, we'll be looking at the importance of analysis and who are the users. We'll break it down into liquidity, profitability, operations management, solvency, capital market performance, and then you may recall horizontal and vertical analysis, where we compare either year over year or various line items within the financial statements against one common denominator. So first of all, get started. As far as the importance of financial statements analysis, is it allows to provide additional information that might be useful to both internal and external users. So the various analyses could be used by internal users, such as managers or executives, to help identify areas of concern where corrections might be required, or areas that are performing exceptionally well, and they should be rewarding the people that helped drive those great results. From the external side of things, you typically have investors or suppliers that rely on your information. So whether it's shareholders or banks or vendors that you might have longer term relationships with for inventory purchases, et cetera, they're very often relying on your financial statement analysis as well. So as I said before, there are different areas of financial statement analyses, and we'll break it down into liquidity, profitability, ops, or operations management, and solvency. And we've got the definitions here, which we will cover in each of those specific areas. If you're looking for some example problems to apply your learnings to, in the workbook, you can look at these various examples, question 1 and 2 of both A and B type questions. So let's jump into the first category, being liquidity. And we will use a set of financial statements for Leon's Furniture Limited from the years 17 and 18 as an example throughout today's PowerPoint. So for example, we've got the comparative balance sheets here, and they're all presented in thousands of dollars. On this first page, we have their total assets growing from 1.66 million to 1.72 million. Hopefully you can see my screen here where I'm circling, and it's broken down between current assets and non-current assets. This next slide here shows the liabilities and equity portion of their balance sheet or statement of financial position for those same 2 years. Same total, liabilities and shareholders' equity equals the assets, of course, broken down between current and non-current liabilities, and then the various components of the shareholders' equity. So when we're talking about liquidity, first of all, we're looking at the ability of a company to convert whatever assets they have as current assets to pay their short-term debts, so their short-term liabilities. And those short-term liabilities typically include accounts payable and loan payments. And there are typically 3 common ways to measure liquidity, and that includes working capital, quick ratio, and the current ratio. Working capital is a dollar. So we look at the current assets, take away their current liabilities, and we get what is a working capital. A positive working capital, where their current assets is greater than their current liabilities, means that they have enough liquid assets to pay its immediate debts. Okay. So if we look at Leon's Furniture in this case, 17 versus 18, their working capital did drop drastically from 168,000 to 53,000. These are in thousands, obviously these are millions of dollars. So it dropped, but it's still positive. It is very often found where you could have working capital deficits, where your current liabilities exceed your current assets. Not a great spot to be in. For example, I worked in healthcare for a number of years, and it was very common to have working capital deficits in the hospital sector, just the way they were funded for other purchases and other activities in the organization. But if we compare Leon's Furniture to the industry average, they were way over industry average in 17, but just a little bit under 2018. So it's not horrible. But at the end of the day, we can say that they have enough assets to current assets to cover the current liabilities. That's all we can really imply from this. So working capital, just as a reminder, is a dollar figure. It is not a ratio. So it's hard to say, what is an appropriate number, but it is a number that you need to include when you're looking at other ratios to say, okay, maybe that is an appropriate result. So let's look at current and quick ratios then as we continue continue our discussion around liquidity. So the current ratio is useful to help us determine what the company's ability is to repay its upcoming debts and obligations. This is a ratio of the current assets divided by the current liabilities. A current ratio of 1.0 means they have just enough current assets to pay their current liabilities. Typically, when it comes to the current ratio, you would want a ratio 1.5 or 2. If you're getting down to 1 or lower, probably not in a good spot. That means you have a working capital deficit also. Just keep that in mind. So the current ratio for Leon's in this example, if we look at their current assets and current liabilities for 17 and 18, it's displayed on screen here. The current ratio declined from 1.4 to 1.09, which ties in with the working capital. Working capital declined, therefore this ratio will decline. They're very much interrelated. If we compare their current ratio to the industry average actually improved year over year, but Leon's went down. So in this case, the ratio indicates a healthy situation for both Leon's and the industry. All ratios are greater than 1. However, Leon's experienced a decrease, which means their ability to pay short-term debts has declined year over year. All right, so let's carry on to the quick ratio. So the quick ratio measures the adequacy of highly liquid assets, so cash, short-terms, and accounts receivable, short-term investments, and that's to cover current liabilities. So we just take a portion of the current assets divided by the current liabilities. And this is known also as the acid test ratio. So you see on screen here, the written out formula, and a quick ratio of 1 indicates that the business has just enough liquid assets to pay current liabilities. So the quick ratio is much like the current ratio. The only difference is that the quick ratio excludes some of the current assets that cannot be quickly converted into cash. And those are typically including inventory and prepaid expenses, because inventory, especially when you come to a furniture store, it might take them weeks or months or even years to sell off their inventory. And prepaid expenses is very hard sometimes to go after a supplier that you've prepaid to get the money back. It might take you a month, it might take you longer, if ever. So the quick ratio for Leon's then is displayed on screen over the 2 years, and the quick ratio dropped from a 0.61 to a 0.51. However, they are much higher than the industry average, going from a 0.19 to a 0.21 in those same years. So it means their ability to pay their current liabilities has declined, but they're in a much better position than the industry. That's really all you can imply from all of these liquidity analyses. If you'd like to follow along and do some application exercises, question 3, 4, 5 in the workbook will help you apply some of this learning on liquidity. So let's move over to profitability. And profitability refers to the company's ability to generate profits. The greater the profit you have, the more valuable the company will likely be to any shareholders in the organization. And most analysts, when it comes to external side of things, they use profitability as the ultimate test of effectiveness of management's ability to operate. So let's look at Leon's income statement, and we've pulled up a partial portion of their statement of income, and we'll look at their income first of all. So let's look at their gross profit. Dropped from 954, increased from 954 to 976 on total revenue, just over 2.2 million each year. So fairly flat. The net income for the year, fairly flat as well, from 96 to 111 million. Okay. And keeping some of these numbers in mind, we'll move on to some profitability ratios. So the first one we want to look at is the gross profit margin. So the gross profit margin is used to demonstrate the impact of cost of goods sold on the income statement. The gross profit margin subtracts the cost of goods sold from sales revenue, which is your gross profit. The result of that is divided by net sales. Oops, clicked the wrong button. So just to show you on screen here, gross profit margin equals gross profit, which is sales less COGS, divided by sales revenue. Probably learned this in the previous accounting course. So in this example for Leon's, we have a gross profit margin basically flat year over year, 43% in 2017, 44% in 2018, compared to industry average around the 35, 32% mark. So in this case, the gross profit margin of Leon's did increase slightly, 1%, and was above the industry average for both periods. Actually, you would suggest they outperform on a gross profit margin perspective compared to their peers in the industry. Similar ratio for profitability looks at the net profit margin. So that looks at the net income divided by sales revenue. And just like with gross profit margin, a higher net profit margin is generally considered better. Although you always need to compare to industry averages. And how do they compare year over year? Are they going up? Are they going down? Are they better than the industry, et cetera? So let's look at the net profit margin for Leon's for those 2 years. And we show a 4% and a 5% for those 2 years compared to industry averages of 7 and 6. So if you can remember, their gross profit margin was better than the industry, but their net profit margin is not as good as the industry. So their net profit margin has increased, but they continue to be behind the industry average. Okay. Another profitability analysis ratio would be the ROE, the return on equity. And that looks at the relationship of the net income earned by the organization divided by the average shareholders' equity. So those shareholders that are leaving funds in the organization, what's the rate of return approximately on those investments, those equity investments? Okay. And oh yeah, the other thing that's important is net income comes from the income statement, shareholders' equity comes from the balance sheet. Whenever we use information from the balance sheet, we always use the average because the balance sheet's as at a point in time and the income statement is for a period of time. So when you have a ratio that looks at both statements, any items coming from the balance sheet need to start and end at the same time as that income statement. So you need to average over that period. So bringing in Leon's examples for 17-18, we look at the net income of the 2 years, 96 and 111. And we have the average shareholders' equity, and the calculations are on screen there, looking at the opening plus the closing divided by 2. Okay. So we have the ROE for Leon's going from 13 to 14% over those 2 years. But their industry average, their competitors are 21 and 17. So they're underperforming compared to the industry, but they have slightly improved internally. Okay, so it might indicate that other companies in this industry are a better investment if you were choosing to invest. It might. But again, you want to look at all of these different ratios together at the end of the day. Another profitability analysis ratio is the return on common shareholder equity. And this is where we look at the net income less any preferred dividends divided by the average common shareholders equity. So preferred dividends are subtracted from the net income in order to reflect the fact that a portion of that net income belongs to the preferred shareholders and not the common shareholders. If the preferred shares are not cumulative, then dividends are subtracted only if they've been declared, not if they're accumulated. Okay. Let's look at another ratio, return on assets. Return on assets looks at how does the company do with what it has? So based on the value that they've generated over the years, how do they use those assets that they've maintained to generate net income? So it looks at net income divided by the average total assets. If we look at Leon's numbers from the earlier slides, we have average total assets increasing slightly, net income increasing slightly. So our return on assets has increased from 6 to 7%, while the industry has decreased from 8 to 7%. So basically, we're on industry average in this case, but we have improved year over year. What this tells us is that in 2018, Leon's rate of returns were about 7 cents for every dollar invested in assets. It's not too bad of a rate of return. Another similar ratio would be asset turnover. So how well is the business using assets to generate revenue? And so this formula looks at total revenue divided by the average total assets. The asset turnover measures the ability to generate sales revenue from those assets. And the higher the number, the better. So let's look at Leon's again. And our asset turnover went from 1.35, a slight decline to 1.32, but better than the industry averages depicted on screen. So what this means is for 2018 is an asset turnover of 1.32 means they generated $1.32 of revenue for every dollar tied up in assets. Good or bad? They're better than the industry. All right, let's flip pages over to operations management type analysis. So operations management analysis looks at the ability of the company to manage its assets, such as inventory and AR. In inventory, there are two different ratios that are typically calculated. The first one looks at inventory turnover ratio. So it looks at the number of times on average the inventory is sold during the period. So it looks at the liquidity of the inventory. So inventory turnover ratio, you might recall this from before, is cost of goods sold divided by average inventory. Okay, so let's look at this. We're going to assume that the balance inventory for Leon's was as depicted on screen. And so therefore we had an average inventory turnover of the 2 years going from 4.02 down to 3.91. So a slight decline, but it's consistent and it's very similar to the industry. The other sale related to inventory is the days sales in inventory. So it looks at the number of days it took to turn over their inventory during the year. So we look at the average inventory divided by the cost of goods sold times 365, or since we've already calculated the inventory turnover ratio, you take 365 days divided by that inventory turnover ratio. So instead of looking at the number of times they sold their inventory in the year, it looks at how many days are in their average inventory. So it's just the inverse relationship, looking at the per year. So looking at Leon's in this case, they had a day sales inventory of 90.7 last year to 93.4 in the current year, being 2018. Comparable to the industry, but slightly better, because the lower the days, typically the better, which means they're selling inventory faster. Another area that we typically measure is days sales outstanding. So it looks at the number of days it takes to collect receivables. So this is on the cash flow side from customers. It looks at the average accounts receivable divided by the net credit sales. So only the credit sales, not the cash sales, times 365. So this tells us it's the average number of days that the customers take to pay their bills. So looking at Leon's numbers again, our days sales outstanding for Leon's actually a slight decrease year over year from 22 to 21. Compared to the industry average, it actually increased. So if you're looking at Leon's, their actually collection pattern is pretty good compared to some of their competitors. Therefore, they have less cash tied up in accounts receivable from customers. Another example looks at accounts receivable turnover. So it's very similar to the days sales outstanding, but it divides the net credit sales by the average amount of AR. So account receivable turnover equals net credit sales divided by the average AR. Looking at Leon's again, we have that number has increased, makes sense because our AR days sales went down, so therefore our turnover goes up. We replace our AR balance from 16.6 times to 17.2 times to the year, compared to the industry average being about half that. Okay, so the higher the AR turnover, the better in this case, because that means your customers are paying you faster. All right, let's flip over to some solvency. And solvency refers to the company's ability to cover its long-term debts, and it relates to the amount of the debt and the risk the company sold. So 3 different measures of solvency look at the debt to equity ratio, the times interest earned, and the debt to total assets ratio. So let's look at the debt to equity first, and it's used to assess the balance of debt and equity. So it simply looks at that relationship. So the debt to equity looks at total debt or liabilities divided by the total shareholders' equity. So in this example, for Leon's, we actually had a debt to equity ratio that declined from 1.15 to 1.01 compared to an industry average that stayed relatively flat. So by declining the debt to equity ratio, it's actually a positive thing. You actually, as an investor, typically prefer organizations that have a higher equity portion compared to their debt. It also means that people are typically more likely to stay invested longer because they're leaving their value in the equity versus pulling out and forcing a company to borrow. Okay, so it's typically a good thing. Times interest earned looks at the company's ability to cover the interest expense charged on its debt. So this formula is times interest earned equals earnings before interest and taxes divided by the interest expense. So a times interest earned of 1 times means that the business has just enough earnings before deducting interest and tax expenses to cover its interest charges during the year. So you want it definitely higher than 1. So the times interest earned ratio for Leon's in the 2 years increased from 12 to 17, while the industry average was 21 to 17. So we're consistent with the industry in the current year, but we're well below the industry average in the prior year. Okay. Another solvency analysis ratio would be the debt to total assets. So we look at their total liabilities divided by the total assets. And this looks at calculation of Leon's, fairly consistent from 54% to 50% compared to the industry average of 114 to 112. That to me is a good thing. So out of all the investments that they have in the business, they don't have as much debt as compared to the industry. So they're relying on equity more than debt to fund the business. Okay. Then we flip over to capital market performance analysis. So shares that are publicly traded on the stock market, their prices change every day, sometimes by the minute. And the corporation doesn't record all of those changes in its books, like every time a stock value change. So in this example, Leon's does not have any preferred shares. However, its consolidated balance sheet shows that it had over 77 million common shares outstanding at the end of 2018. And the year before had just over 76 million. So some of the calculations that you would perform for the financial statement analysis, one would be the book value per common share. So that number typically represents the value of a common share based on the shareholders' claims to the company assets. So the formula for the book value per common share looks at the total shareholders' equity, less any amount belonging to preferred shareholders, divided by the common shares outstanding. So in this case, we look at the end of 2018, we have $857 million divided by 77 million shares. So the book value per common share is $11.06. So what this tells you is if we had to liquidate and pay off all their debts and there was no payout clauses of extra debt that our financial statements are what they are, is that the common shareholders would likely receive about $11.06 per share once all of the other debt is settled. Another ratio that's used when we're looking at capital market is the dividend yield. So how much is the corporation paying out to shareholders in dividends? So we look at the cash dividends per common share divided by the market price per common share. So we are told that the share price was $14.62 at the end of 2018, and we paid 52 cents per common share in dividends in that year. So that calculates a 3.6% dividend yield for 2018. And that's based on market price, not book price. Just keep that in mind. Another capital market analysis would look at earnings per share. So it's a very common corporate measure for potential investors in an organization, and it measures how much profit is earned for each outstanding common share. So we look at their net income for the year, less any preferred dividends to be paid out of the net income, divided by the weighted average number of common shares outstanding. So in this example, we have $111 million divided by 76 million shares. So in this example, we have an earnings per share of $1.45, and that is shown on its statement of comprehensive income. Another ratio would be the price to earnings ratio. So this uses the price to earning ratio to evaluate their investment in the corporation. So it looks at the relationship of the market price per share divided by the earnings per share currently. So we've calculated both of those over the last few minutes. So we look at the $14.62 was the market value of the share divided by the $1.45 earnings. So we have a ratio of about 10.08. So a positive price earnings share indicates that shares are selling, for a multiple of companies' earnings and may explain why the investors are willing to pay for more each dollar of Leon shares. So if the price to earnings is higher, it could be, based on trajectories of the investments in the organization, et cetera. However, if they will sell shares, it'll likely reduce the share price and generate a lower price earnings ratio. So all these ratios are tied to market conditions, how you're performing to your peers in the industry. So all of this you have to put in a whole shell. You can't just look at any single one of these ratios. So the next few slides then kind of summarize all these different ratios. So slide 50 if you downloaded the PowerPoint. So first of all, in liquidity, we look at working capital, current assets, less our current liabilities, current ratio, current assets divided by current liabilities, quick ratio, as you can see on screen. The profitability ratios as indicated here, so they're all kind of summarized up if you want to use them as a quick reference page for any studying or for any assignments that you're working on. And we have the operations management ratios, our solvency ratios. Then we have our capital market performance ratios. Okay, so those are kind of a summary of the various ratios that you would perform on any investment or potential investment that you have or are considering to have. So now we're going to flip the page for a few minutes on horizontal and vertical analyses. So horizontal is a technique for evaluating a financial statement over a period of time. So it's year over year over year or quarter over quarter, whatever those period cycles are. Or vertical analysis looks down the page and it looks as a percent of some base amount. It could be percent of revenue, it could be percent of total assets, depends on which statement you're looking at. So let's first of all look at an example of horizontal analysis on the balance sheet. So in this case, it's the process of comparing line items in comparative financial statements across a number of years, as I just said. So in this example, Leon's furniture profitability can be analyzed by applying either horizontal or vertical analyses. And this comparative balance sheet is a balance sheet that shows the balances for multiple years. So you would look at year over year. How do they perform? Oops. Gotta go back. Okay, so this first page are the assets. Sorry about that. These are the liabilities and equity for 16, 17, 18. And so what we want to do is you pick a base year. So in horizontal analysis, you typically start with the oldest year that you're looking at, and that way it shows whether you grew or shrunk year over year from 16 to 17 to 18, et cetera, as compared to 16 as your base year. So how you calculate that is you look at the new account balance minus the base year account balance divided by that base year account balance. So in one example, if we look at cash from 16 to 18 on the previous slides, they subtract 43,985 from the year that we are examining and divide the result by that same number. So for example, for 2018 with a cash balance of 90,267, they have an increase of 105%. So that means they more than doubled their cash from 2016 up to 2018. So to describe that in words, we would say the cash balance increased by 105% between 16 and 18. And you would do that calculation for each line or each category as determined. So a little snippet here, and we looked at some of the key subtotals by the different categories on the balance sheet. Cash grew 105% of 16, current assets, 19% higher. Non-current assets basically flat. Assets have grown 7%. Current liabilities, significant impact by 43, et cetera. So you can see that on screen here. Okay, let's move on to some vertical analysis on the balance sheet. So usually the base figure is a total dollar amount, such as total assets. So this next chart shortly will show the percentage of line items by using total assets as the base. So just like dividing by a base year, now you're dividing by a base line item. So the percentage of base figure equals the line item account balance divided by the base figure account balance. So using cash as our example again, we take the 90,267 divided by the 1.7, billion dollars in assets is about 5%. So let's just pull up a little snippet again, just some certain key line items. Assuming total assets is our base being 100%, our cash represents 5, current assets is 38. What you want to do with this is look at the trends year over year. Are your current liabilities continuing to increase, as a percentage of total assets, which in this example they are. That means you're getting a higher likelihood of more items that you have to pay within the next 12 months, which might put you in a cash flow crunch. So you would consider some of those items. And one of the comments we'd like to make here is that the vertical analysis reveals that the current assets represent 38% in 2018, while the current liability is only 35%. So that's a good thing. That also helps support your current ratio that we talked about earlier, is that the relationship of current assets to current liabilities, if one's higher than the other on the vertical analysis, that tells you that you have a positive working capital or a current ratio greater than 1. All right, so let's flip over to the income statement then for a minute. Horizontal analysis. Again, you always pick a base year and look at whether income's increasing or decreasing. So in this example, we pull out some of the key line items and we look at the key figures in the top left. What are they as the percentage of the base year? And then you can actually talk about the percentage change from the base year. So in total revenue, for example, we went up 3% in 17 and went up 5% of the 16 balances in 2018. So these are all increases. So how this comes into play is if our revenue is going up 5%, but our cost of goods sold went up maybe 10%, tells us our cost of inventory is increasing faster than our revenue. That's not a good thing. But in this case, our total revenue went up faster than our cost of goods sold. That means we're generating more gross profit to help cover other operating expenses. Okay, and our total operating expenses increase in line with our total revenues. That means we're not shrinking our net income percentage, which is good. Just some summary notes here. Our cost of sales operating expenses increased proportionally over the base year. However, the net income increased substantially. How could that be possible? And then if you look back at the income statements, you'll notice that the interest expense was much declined in 2018. Okay, so they look like they're in a decent position. If you were a bank, you would also use the vertical analysis to convert income statements to percentage of total revenue for the year. So if we looked at total revenue being the base item, we would use that as 100%. And then we look at the various line items. Cost of goods sold, they're running 57, 56%. So it's remaining consistent. Gross profit, slight increase. So as the gross profit increases, you hope that's a good thing as a bank or creditor. Net income's remaining fairly consistent. So, they're a relatively stable organization. So that's all we really have to cover. And again, I'll do a little video of some workbook examples.